Elon Musk paid an 11% tax rate. Jeff Bezos, in some years, paid 0. Mark Zuckerberg, less than 1%. You might be paying 20, 30, even 40% of your income in taxes. Meanwhile, the wealthiest people in the world legally pay almost nothing. This isn't a conspiracy, it's not fraud. It's a system designed with specific incentives, and it has a name. It's called buy, borrow, die. And once you understand it, you'll never look at wealth the same way again. Most people think the ultra-wealthy pay less tax because they hire expensive accountants who find loopholes. That's partially true, but it misses the bigger picture. The real reason isn't clever accounting. It's something far more fundamental. Billionaires don't make money the way you do. When you work a job, you earn income. That income gets taxed immediately, before you even see it. Payroll taxes, income taxes, it's automatic. But billionaires, they don't take salaries. Elon Musk's official salary at Tesla, $0. Jeff Bezos took $81,000 a year from Amazon, less than many software engineers at his own company. So where does their wealth come from? Stock. Their wealth is in shares, pieces of ownership in companies they control. And here's the key. Stocks aren't taxed until you sell them. This is called unrealized gains. The stock grows. Their net worth explodes. But on paper, they haven't made income. No income means no tax. But wait, if they're not selling stock and they're not taking salaries, how do they pay for private jets, mansions, and yachts? That's where the strategy begins. The first step is simple. Buy. But not just anything. Buy assets that grow in value over time. Real estate, stocks, art, businesses. Let's say you're a billionaire. You own 10% of a company. That company is worth $100 billion. Your shares are worth $10 billion. 5 years later, the company doubles in value. Now it's worth $200 billion. Your shares, $20 billion. You just made $10 billion. But here's the critical part. The IRS doesn't consider that income. Why? Because you didn't sell. The stock just sat there, appreciating. And as long as you hold it, there's no taxable event. This is the foundation of wealth building. You don't earn money, you own things that become worth more. But there's a problem. You can't buy groceries with stock certificates. You can't pay for a mansion with shares of Tesla. You need cash. So the obvious move is to sell some stock, right? Wrong. The moment you sell, you trigger capital gains tax. If you sell $100 million in stock, you could owe $20 to $30 million in taxes immediately. That's a huge cost. It reduces your wealth. It limits future growth. So billionaires don't sell. Instead, they do something smarter. Here's where the strategy gets brilliant. Instead of selling stock, billionaires borrow against it. They walk into a bank and say, I own $1 billion in stock. Lend me $100 million. I'll use the stock as collateral. The bank agrees. Why? Because the loan is backed by assets worth far more than the loan itself. If the billionaire defaults, the bank seizes the stock. It's a safe bet. Now the billionaire has $100 million in cash. But, and this is the key, loans aren't income. The IRS doesn't tax borrowed money. You can borrow $10 million, $100 million, even $1 billion and pay zero taxes. So now the billionaire lives off this loan. They buy houses, cars, fund their lifestyle, all without selling stock, all without paying taxes. But wait, don't they have to pay back the loan? Eventually, yes. But here's the trick. The stock is still growing. A few years pass. The $1 billion in stock is now worth $1.5 billion. So the billionaire goes back to the bank and says, my collateral is now worth more. Give me another loan, this time $200 million. The bank agrees. The billionaire uses part of the new loan to pay off the old loan. They keep the rest as tax-free spending money. This cycle repeats: borrow, spend, refinance, borrow again. The debt grows, but so does the wealth. And because they're never selling, they're never paying taxes. The interest rates on these loans, often around 2 to 3%, far lower than the capital gains tax rate of 20 to 30%. It's not a loophole, it's the system working exactly as designed. But there's still one problem. Eventually you die, and when you die, the IRS comes knocking, right? Here's where the strategy becomes permanent. When the billionaire dies, the stock passes to their heirs. And this is where US tax law does something extraordinary. It's called the stepped-up basis rule. Here's how it works. Let's say the billionaire bought stock for $100 million. Over decades, it grows to $10 billion. If they sold it before dying, they'd owe capital gains tax on $9.9 billion. But they never sold. When they die, the stock transfers to their children, and the IRS resets the cost basis to the current market value. The original purchase price erased, the $9.9 billion in gains vanished. The new cost basis is $10 billion. Now, if the heirs sell the stock immediately, they owe zero capital gains tax because there are no gains. The basis was just reset. Decades of growth, billions in appreciation, all tax-free. The loans, they get paid off using the inherited assets. The heirs can refinance or sell just enough to clear the debt, and because of the stepped-up basis, they pay little to no tax doing so. This is why it's called buy, borrow, die. Buy assets, borrow against them, die before selling, and the tax bill disappears. The system isn't broken, it was designed this way. So why does the tax code allow this? It comes down to incentives. The US tax system is built to encourage long-term investment. The government wants people to build businesses, hold assets, and create jobs, not sell everything for quick cash. If you tax unrealized gains, gains on paper that haven't been sold, you force people to sell assets just to pay the tax bill. That can destabilize companies and markets. The stepped-up basis rule was designed to prevent double taxation and encourage generational wealth transfer without forcing families to liquidate farms, businesses, or estates. But the unintended consequence: the ultra-wealthy can live off borrowed money indefinitely, paying minimal taxes while their fortunes compound. This isn't about morality, it's about structure. The system rewards asset ownership. It punishes earned income. If you work for a paycheck, you're taxed immediately and heavily. If you own appreciating assets, you can defer taxes indefinitely, and in some cases avoid them entirely. Should this change? That's a policy question. Some argue for a wealth tax. Others propose taxing unrealized gains above a certain threshold. Some want to eliminate the stepped-up basis rule, but until the incentives change, the behavior won't. Because here's the truth: the ultra-wealthy aren't cheating. They're playing by the rules. Rules that were designed to favor ownership over labor, capital over income, long-term wealth over short-term earnings. And once you understand the system, you see it everywhere. It's not a conspiracy. It's the code. This is how the ultra-rich money-making mechanics works. If you want more insights like this, subscribe to our channel, and don't forget to like and share this video to spread financial awareness. Thanks for watching.